Did you know that 95% of retail traders fail because they treat the market like a casino, while quants treat it like the house? It is a brutal reality that separates the wealthy from the hopeful. While you obsess over a single trade, sweating as the candles flicker red, a quant fund is running thousands of concurrent positions, completely indifferent to the outcome of any single one. They know that in the law of large numbers, the individual event is irrelevant. This is the fundamental disconnect. You trade for the dopamine hit of being right. They trade for the statistical probability of profit. They have removed the ego from the equation completely. When you buy, you are hoping. When they buy, they are executing a rigorously tested hypothesis with a known probability of success over a distinct time horizon. They are not smarter than you. They are just more disciplined and mathematically consistent. They don't chase the market. They trap it. But to stop being the gambler and start being the house, you must first understand the invisible ocean of information that you are swimming in blindly.
How much data is generated in a single trading day? Quants consume petabytes of information that go far beyond price and volume charts. While you look at a simple moving average, they are scraping satellite imagery of oil tankers, analyzing credit card transaction data in real time, and using natural language processing to gauge fear in central bank statements. This is the realm of alternative data. It is the difference between driving with your eyes closed and having a GPS that sees the future. They know a retailer's earnings will miss expectations before the CEO does, simply by counting cars in parking lots via orbital cameras. They aren't predicting the future. They are observing the present with higher resolution than you. This information asymmetry is the massive wall you keep hitting. You are reacting to the ripples while they are watching the stone hit the water. But access to massive data is useless without the right lens. To use this power, you must abandon the idea of prediction and embrace a concept that feels entirely unnatural to the human brain.
Why is "I think the market will go up" the most dangerous sentence in trading? Because quants never ask what the market will do next. They ask what the odds are. Prediction is a fool's game played by pundits and amateurs. Quants operate solely on expected value. They calculate the probability of a win multiplied by the potential reward, minus the probability of a loss multiplied by the risk. If the number is positive, they take the trade. If it is negative, they walk away. It is cold, hard, unfeeling calculus. They don't care about the narrative or the news story. They care about the distribution of outcomes. They accept that losing is a mathematical certainty and a cost of doing business, not a reflection of their intelligence. By shifting your mindset from what will happen to what is the probability, you instantly stop gambling. But even with the odds in your favor, there is a hidden speed trap that can destroy your edge before you even click the mouse.
Did you know that a trade can be executed and closed in the time it takes light to travel from your eye to your screen? High-frequency trading firms fight for nanoseconds. They spend millions laying fiber optic cables in straight lines through mountains just to shave off a fraction of a millisecond. When you click buy on your retail brokerage app, your order is often routed through these sharks who see it coming, step in front of it, and sell it back to you at a higher price. This is payment for order flow, and it is how the infrastructure is rigged against slow money. You cannot beat them at speed. Trying to day trade on the minute chart against an algorithm that operates in microseconds is suicide. You are playing a video game with a 10-second lag. The quant knows you can't compete here. However, there is a way to beat them, and it involves stepping out of the fast lane and looking where the algorithms are blind.
What if I told you that 90% of the price movement you see on a chart is just random noise? Humans are pattern-seeking machines. We see faces in clouds and trends in random walks. Quants spend years filtering out this noise to find the signal, a true recurring market anomaly. They use digital filters to strip away the random volatility and expose the underlying mechanics of price. While you are drawing trend lines on a chart that is statistically random, they are identifying subtle inefficiencies that repeat over time. They know that markets are mostly efficient, meaning price reflects all information. But they hunt for the brief moments when the market breaks. It requires immense skepticism. They test everything and assume nothing. Most of what you think is a strategy is just luck disguised as skill. To find a true edge, you have to stop trusting your eyes and start trusting the data. But finding a signal is dangerous if you fall into the trap of rewriting history.
Why do strategies that make millions in a simulation go bankrupt in the real world? It is called overfitting, and it is the quant's deadliest sin. Imagine tailoring a suit so perfectly to a mannequin that it rips the moment a real person tries to move in it. That is what happens when you tweak your indicators until they look perfect on past data. You aren't discovering a strategy, you are memorizing history. Quants know that the past is a guide, not a map. They use out-of-sample testing, hiding half their data to see if the strategy works on charts it has never seen before. They stress test their systems through market crashes and volatility spikes. If a strategy only works in a bull market, it is not a strategy, it is a beta play. You must learn to test your ideas without cheating yourself. But even a robust strategy will fail if you don't respect the single most important mathematical formula in gambling and trading.
What is the number one reason profitable traders eventually go broke? It isn't bad picks, it is bad sizing. You can have a system that wins 60% of the time and still lose all your money if you bet too big on the losing streaks. Quants use the Kelly criterion and position sizing algorithms to determine exactly how much capital to deploy on a specific trade based on its conviction and volatility. They know that risk of ruin is the only metric that matters. Survival is the prerequisite for success. While you go all in because you feel confident, a quant calculates that betting more than 2% of equity dramatically increases the probability of a total account wipeout. They preserve their capital like a fortress. They optimize for geometric growth, not a lucky lottery ticket. Understanding this math changes everything. But protecting your money isn't just about size. It is about knowing how your bets interact with each other.
Did you know that during a market crash, the correlation of all assets approaches 1? That means when panic hits, everything falls together. You think you are diversified because you own tech stocks, crypto, and real estate, but quants know these are all bets on the same liquidity factor. When the liquidity dries up, your diversification vanishes. Quants build portfolios using correlation matrices to find assets that truly move independently of one another. They hedge their bets mathematically, ensuring that a loss in one sector is offset by stability in another. They don't just pick winners. They constrict a portfolio that is robust against chaos. They look for uncorrelated alpha. If you don't understand the invisible strings connecting your positions, you are leveraging risk without knowing it. To trade like a quant, you must stop collecting stocks and start building a balanced ecosystem. Once you are safe, you can start exploiting the two primary forces that move markets.
Why do rubber bands always snap back? Markets operate on a similar physical law called mean reversion. Quants know that when a price stretches too far from its average value, the statistical probability of it returning to the center increases drastically. They don't buy the dip because it feels cheap. They buy because the standard deviation suggests the move is an outlier. They measure the z-score of a price to see how rare the move is. If an asset moves 3 standard deviations from the mean, it is a statistical anomaly that creates a high probability trade. This is buying fear and selling greed, quantified. But this strategy requires nerves of steel, as you are often stepping in front of a freight train. You are betting that sanity will return to the market. However, sometimes sanity does not return, and the rubber band snaps. That is when the second great market force takes over, and if you are on the wrong side, it will crush you.
Did you know that Newton's first law of motion applies to stock prices? An object in motion tends to stay in motion. This is momentum, the arch nemesis of mean reversion. Quants know that over specific time horizons, winners keep winning and losers keep losing. They don't try to predict the top. They just ride the wave until the math says the energy is dissipating. They ignore the valuation. It doesn't matter if a stock is expensive if the momentum vector is pointing up. They use complex algorithms to detect the strength of the trend, looking for accelerating volume and price velocity. While you are scared to buy an all-time high, the Quants model is triggering a buy signal because the trend is robust. The trick is knowing which regime the market is in, mean reverting or trending. Mistaking one for the other is the fastest way to lose money. But there is a third way to trade that doesn't rely on direction at all.
Is there such thing as free money? In the world of quants, yes, but it is fleeting. Arbitrage is the art of profiting from price differences of the same asset in different markets. If gold is trading for one price in London and a higher price in New York, a quant algorithm buys and sells instantly to pocket the difference. It is risk-free profit. While pure arbitrage is rare for retail traders, statistical arbitrage is the bread and butter of quant funds. They find pairs of stocks, like Pepsi and Coke, that historically move together. When they diverge, they short the winner and buy the loser, betting the gap will close. They don't care if the market goes up or down. They only care about the relationship between the two assets. This is market-neutral trading. You profit regardless of the economy. But finding these relationships requires digging deep into the microstructure of the market where the robots live.
Can a computer learn to trade better than a human? The answer is terrifyingly yes. Modern quants are deploying machine learning and neural networks that evolve on their own. These systems ingest millions of data points and find nonlinear patterns that no human brain could visualize. They adapt to changing market conditions in real time. A traditional algorithm follows a set of rules. A machine learning model writes its own rules. It learns from its losses. It detects subtle shifts in volatility and liquidity that signal a regime change. While you are reading a book on technical analysis from the 1980s, these AIs are rewriting the textbook every single second. They are the ultimate predators. However, they suffer from the black box problem. Sometimes even their creators don't know why they took a trade. But you don't need an AI to beat the market. You just need to understand how your orders are actually executed because you are leaking money every time you click trade. Did you know you lose money the moment you enter a trade, even if the price doesn't move? It is called slippage and spread, and it is the silent killer of returns. Quants obsess over execution. They use iceberg orders to hide their true size, buying small chunks so they don't spook the market. They use VWAP, volume weighted average price algorithms, to ensure they get the fair price throughout the day. Retail traders smash market orders and pay the premium. Quants provide liquidity. You consume it. Every time you pay the spread, you are tipping the dealer. Over 1,000 trades, this friction destroys your edge. Quants optimize their code to minimize market impact, saving millions of dollars a year just on better entry prices. You must learn to use limit orders and patience. Stop chasing price. Let the price come to your level. But here's the shocker. Despite all their technology and capital, there is one massive advantage you have over a quant fund. Why can you make returns that a quant fund can only dream of? Because you are small. A quant fund managing billions of dollars is like an elephant in a bathtub. They cannot move without splashing water everywhere. They cannot trade small-cap stocks because their position size would own the entire company. They are forced into the most efficient, crowded markets, like the S&P 500. You, however, are a nimble speedboat. You can enter and exit illiquid markets instantly without moving the price. You can target niche opportunities that are too small for quants to bother with. This is your capacity constraint advantage. You can target high volatility plays that would ruin a fund's risk metrics. You can sit in cash for months waiting for the perfect setup, while they are forced to trade every day to justify fees. Your agility is your edge. Stop trying to play their game of speed and start playing your game of flexibility. Now, how do you build a system to harness this? How do you turn a hunch into a system? You must stop being a discretionary trader and become a systematic one. This means writing down your rules in code, or at least on paper, with zero ambiguity. A quant system has 4 strict components: setup, entry, exit, and sizing. I buy when it looks good is not a system. I buy when the 50-day average crosses the 200-day average and RSI is below 30 is a system. It must be testable. If you cannot quantify it, you cannot trade it. You need to define your edge mathematically. By systematizing your approach, you remove the emotional decision fatigue that leads to mistakes. You become the pilot of a checklist, not a cowboy on a wild horse. This requires work. It requires data. But it is the only way to ensure your results are repeatable. Once the system is built, the hardest part isn't the math. It is the psychology of sticking to it when things get rough.
What is the hardest thing for a human to do in trading? Doing nothing when the system says do nothing, and acting instantly when the system says act. Quants trust their models blindly because the math has been proven. Retail traders second-guess their systems. They override the rules because they read a tweet or have a bad feeling. This is called style drift, and it destroys the statistical validity of your strategy. If you override the system, you are no longer trading the system. You are back to gambling. The discipline to execute a losing trade exactly as planned is the hallmark of a professional. Quants know that drawdowns are part of the probability curve. They don't panic. They analyze. To trade like a quant, you must surrender your ego to the rules you created. You must become a machine operator. If you can master this discipline, you unlock the final transformation that separates the profitable from the destitute.
Are you ready to stop being the prey and start being the predator? Trading like a quant isn't about learning Python or buying a supercomputer. It is a fundamental shift in philosophy. It is realizing that the market is not a place to get rich quick, but a complex mechanism of probability extraction. It is accepting that you know nothing and that data knows everything. It is moving from intuition to evidence, from hope to expectancy, and from gambling to business. The tools are available to you. The data is out there. The math is universal. The only variable left is you. Will you continue to feed the liquidity machine with your emotions, or will you step back, analyze the odds, and trade with the cold precision of the house? The age of the gut feeling is over. Welcome to the age of the quant. The market is waiting, and for the first time, you have the blueprint to beat it. Now go look at the numbers.